China's Communist Party Congress sets national policy goals and confirms its top leadership. But the overarching theme emerging from this Congress is one of continuity rather than change.
With President Xi still pretty much in charge, we don't expect a drastic shift away from a state-led economic growth model. We still think China will continue to make productivity-enhancing reforms, but this will be carried out in a way that it will still be state-led.
The Party Congress has also doubled down on the zero-COVID policy.
A lot of people still have illusion of China will losing zero COVID strategy very soon. But my own message is please don't underestimate the determination of Xi Jinping on keeping zero COVID strategy. Because after all, zero COVID strategy is Xi Jinping's signature public policy.
This is going to create uncertainty for both consumers and businesses, hindering the recovery in private consumption and private investment. We think that this economic recovery this time will be quite different for China. It will be rather bumpy, and it will fall short of previous economic recovery cycles due to the ongoing COVID-0 strategy.
The slowdown of the world's second largest economy marks a shift in the country's growth goals from high speed to high quality.
The economy will not see such rapid pace of growth like what we have seen in history. It will be much slower. There are a lot of forces that are dragging down on growth, such as demographics. The government continues to seek stability in the economy. It is shifting its growth drivers from being an export-led one to a domestic demand-led one. It is shifting its growth driver away from the troubled real estate sector towards the high-end tech sector, which will form the basis for sustained development over the coming decades.
In the next 5 years, it's quite possible for us to actually see the growth rate to slow down to around 4.5 to 5%. If we look at it from an even longer perspective, for example, let's say 20 years, it can actually go down to close to 4%, which is, of course, there are other problems such as aging population or productivity.
Analysts note the shift in President Xi's priorities, from economic growth to security and national self-sufficiency. The emphasis on security comes amid increasing tensions with the US and a reiteration of Beijing's commitment to taking control of Taiwan.
China will be much more self-isolated than rely on themselves. The relationship with the outside world will not be improving. Then Xi Jinping's wolf warrior diplomacy will double down instead of being declining. His legitimacy base will be moving from economic growth to security. Then this signal is very strong and also will affect the relationship between China and the outside world. And also this legitimacy change will affect business and investment. It means that China maybe will say beautiful things about foreign investment, but in the meantime, they may not actually really rely on external circulation. They will really rely on internal circulation. So they will focus very much on domestic capacity instead of the trade and all kinds of deals with the outside world.
There could be more government support towards its own firm in China, which basically means that foreign firms may actually face a huge, basically bigger competition when it comes to receiving this sort of government support and subsidies. So this balance may be tilted even further.
Common prosperity has also become a defining theme in Chinese politics. This means the state will play a greater role in regulating and redistributing income and wealth.
As we have seen in the crackdown of the big tech sector, that's in the name of common prosperity, to distribute wealth and income better across the country. So I think based on this crackdown, it is very hard for investors to feel very confident about investing in China going forward. And with President Xi still continuing to maintain its common prosperity drive, I think private investors will be on their toes. They will be rather cautious about investing in China.
In the first 7 months of this year, foreign direct investment in mainland China rose 17.3% to almost 800 billion yuan. If investment from Hong Kong is taken out of the picture, new investments grew 8% in 2021. But amid China's current economic uncertainty, analysts say businesses are seeking diversification.
Companies may want to have their production line in different areas in Asia. So that means that China may not be the only choice for foreign firms to invest in Asia in the future, which doesn't mean that they will quit China, but maybe in the past, if they need to invest $100, maybe $80 will be in China, but in the future, maybe 50 in China, another 30 in ASEAN or 20 in India. So I guess from the foreign firm perspective, this ongoing shift seems to be happening.